Thank you. I'm Jane Freeberg Sarma. I'm with the New York office of Reed Smith, where I do restructuring and bankruptcy work, some finance work, as well as U.S. sanctions. Since this is the year of the monkey under the Chinese calendar, but I think it should be called the year of the restructuring under the shipping calendar. So I'm very fortunate to be up here with our distinguished panel today. And let's start things off by asking each of our panel members to introduce themselves. Evan?
Evan Cohen, former DVB, and as of the beginning of the year started a new practice, DC Maritime Partners, Restructuring Advisor.
Hi everyone, Esben Christensen. I am a Managing Director with Alix Partners. We have a global team that's focused on the maritime industry, and I coordinated for the Americas.
Ivan Lehon, I'm a partner at Ernst & Young, as well part of our global shipping team.
Hi, I'm Christoph. Doesn't work?
No.
Hi, I'm Christoph Geck-Schlich. I'm the CIO of the Offen group, and obviously, historically, over the last couple of years, we have been looking at various restructurings for the company ourselves and restructuring within the KG market.
Thanks. We're the slot right before lunch, and we're not going to let anybody miss any food because lunch is one of my 3 favorite meals. So if you have a question, please raise your hand during the presentation because I'm not sure if we'll have time afterwards. So let me know if you have any questions. It's always more interesting when the whole room is engaged in a discussion and not just up here. So please catch my eye if you do have any questions. So let's kick things off with restructuring. What are some red flags that a borrower, a ship owner, looks like it may be having some trouble, may need to go into restructuring? What sort of warning signs should their lenders, should their equity holders be looking at?
Yeah, I'm more curious about the ones that aren't eligible for restructuring. I think someone mentioned it earlier, it's all about liquidity. I think everybody's under pressure, so warning signs I think have all mostly been passed. So as a banker, 3 months ago, I would have said the covenant breaches, but those have long been breached.
Yeah, I think I would agree with that. I mean, and again, it's a sector by sector, but if you run dry bulk vessels, then by definition, that probably is a warning sign at the moment. You know, technical defaults and everything is something that we always look at, but cash is king. I think somebody on the previous panel said that, and what we always tell owners and bankers that are looking at situation is whether or not they have visibility to realistic runway on liquidity. And I mean realistic in the sense that, ship owners generally are optimistic people, and, it's one thing to do cash projections, but it's another one to really run through the stress testing and make sure that you're equipped. And in this market, you gotta have runway, and if you don't feel comfortable you have runway, that to me is the biggest warning sign out there.
Yeah, I mean, not much more to add to that, but other than I think it's all in distress, and so the ability to have equity or some sort of flexibility to move around and be a little bit flexible, then you have a little bit space to live. But other than that, I think what everybody else said.
Nothing to add.
There was just one follow-on comment. It was interesting. For those of you who sat through most of the panels, in the morning there was the dry bulk ship owner panel, and they said, we're at the bottom of the market. It's really, this is the time. It's maybe maximum 2017 recovery. And then a couple panels later, it was the shipping bankers who said, 18, 19. So it depends on who you ask about the warning signs.
Well, given that we're all looking forward to 2017 or 18 or 19, what should be done now? What's a good first step for a ship owner looking at its restructuring process? Where do you start?
Well, I think it's not like what the ship owner wants, it's more like what the bank wants, and I think that's what has changed dramatically, at least from my point of view in the German market, is that banks are being much more active and approaching us as owners and putting pressure on us. I think that is because the banks are facing much more pressures from their regulators. And I think this is what really could be a different topic for 2016 and 17, is that the banks are finally moving after having kicked the can down the road for the last, I don't know, 6-7 years. I mean, that's what we experience with a lot of the Landesbanks at the moment. And I think that's actually a good thing, because like somebody I think in the previous panel, Michael Parker, I think said, we don't need any more vessels. There's enough vessels which we can restructure and take a look at. And I think that's really what's going to happen.
Yeah, and we think that, I mean, one of the first things you want to do is you really want to start the communication, and I'm assuming, right, that the communication's been going on, but if the dialogue isn't continuous and the banks don't feel comfortable, then they're going to take different positions. They might look at other ways to deal with their issues, because obviously, the discussion about the regulators, the AQR and the like. So, the communication is key in the restructuring, and I think just getting everybody on the same page, because, we're ultimately going to have an issue with valuation at the end of the day. So if everybody's on at least having this dialogue, then I think you can move your way towards a successful restructuring.
Okay.
Yeah, I mean, I guess to add to that, I definitely agree, communication and early on, the earlier the better. Even in this market where it may not seem that there are a lot of opportunities and options and different paths, the one thing that is a fact is the longer you delayed communicating, the fewer that option set, the fewer number of paths you have available to you. So communication and any proactive steps, as minor as they may seem, to address any leakage issues, cost issues, making sure that everything is run as tightly as possible, while it may not ultimately avoid a restructuring. It buys goodwills for the stakeholders, and it sets you up for the discussion that has to be had at some point.
Yeah, now that I'm on the first few mandates for the new company have been for the owner side rather than the banker side. And if you're lucky enough to just be starting a restructuring process, you lock up all the family silver, all the cash, all the equity. You lock it away, the bank can't touch it, because then you're going to have one good first discussion. I'm going to put in more money, and you're going to give me a 2-year runway. And that's capitalize on that asset. What we heard from the bankers panel earlier, or from Michael, the contribution from the owner is what the banks need right now. So that's your card, and you play it wisely.
So when's the best time to play a card like that? Is it early in the game or later in the game, or does it really matter?
It's when you get your 2-year runway. When you get all the covenants you need to survive.
Yeah, I think one of the things that's a little bit different when you think back, where we are now versus where we've been before in the cycle, it seems like we've been in a restructuring cycle since 2009, 10, maybe even earlier. But what's a little bit different this time is the depth. Certainly for dry bulk, this is now at a point where, a kicking the can type strategy is just not an option any longer, because we don't just have liquidity to service debt. We don't have liquidity to run the operations. So in a lot of ways, that discussion is inevitable at this point, because the runway is just not there. So that discussion you're going to have, and you may not actually decide the timing if you don't act quickly.
Yeah, you mentioned the depth of this cycle is something that's fundamentally different from other shipping cycles we've seen. Is there anything else about the cycle this time around that's a different or a wild card?
Well, again, I think it's really, if you come to Germany, it is really the status of the banks and where the banks are at the moment, and that they're really being forced the first time to take different actions than the last 7-8 years. So I think the difference is really that most of the banks they can't move anymore, and they have to do something.
Yeah, I also think this is the third dip. So I think there have been funds that have been hurt with each dip, thinking that, okay, we're at the bottom. So there was little more, I would think, enthusiasm in jumping in, and now, you know, we feel we're at the bottom. I heard the panel before this. You know, if you talk to, you know, some other people, we might not be at the bottom. And so I think that's an issue. And then I also think, you know, in terms of some of the banks, you know, have they really written down their positions to where they're comfortable in moving some of their loans? And that's also not clear to me.
I think just to add an example, I like a couple of months ago, probably if a bank would have put a vessel into insolvency and you talk to the insolvency lawyer, they would still got funding from the bank in terms of working capital if they needed. That has changed dramatically. So at the moment, I think the bank doesn't get any, the insolvency lawyer doesn't get anything anymore in terms of OPEX or CAPEX for the vessels from the bank. And that's the first time, I think that's a game changer in various situations.
I think adding to that is, I think what's a little bit different this time versus recent years is, my sense is that, from my perspective, it's a bit more of a binary discussion in a lot of situations between the ship owner and the bank. Whereas before there was more interest from alternative financing, you know, hedge funds, private equity, that may have been in the capital structure somewhere, or maybe interested in getting into the capital structure and have been a catalyst for getting something done. In a lot of situations, that interest is not there at the moment, and so it really becomes a discussion between, you know, the current owner or current equity and their current creditors that may not be willing to invest further and give new runway. So in a way, it's a simpler discussion, but in another way, it's a more complicated discussion from a restructuring perspective, because getting that deal done is that much harder when you have a limited cast of willing characters.
Yeah, and just to add, and then you're also seeing some of the structures that are already in place. So you have your discount, you know, your discount lenders, and then you have your par. So you have your banks, you have your hedge funds, and you're trying to get to a solution there. And right, so and their tenors are off. Right, some are thinking, okay, you know, we have short to medium as opposed to medium to long term, and management's view. So as you said, I mean, it's much more complicated, and to what we said earlier, I mean, I think the communication process is extremely important when you have all these different, you know, perspectives.
If you could, one sort of, I guess, optimistic, which is a funny word in a restructuring panel, but one optimistic note is, on the binary side, when you now just have the lender and the owner, the thing that's a bit different now is that everybody's feeling the pain. The bank is going to lose something, and the owner is going to lose something. And there's the room for a deal there. So there is a sense of, okay, if we play fair, and everybody, we try to minimize the overall loss, you can find a deal done.
Okay. So I'm going to take a small pause now and ask for any questions, because we're about halfway through. Oh, and I knew I was ignoring somebody. Yes. Yes. Oh, okay, yeah.
Can you hear me? Yes. I think I wouldn't say there aren't other capital providers not watching, both in dry and offshore. I think the problem for the offshore sector is there is no liquidity in the assets. Pretty well every other sector of shipping, there is liquidity of some sort in the asset, as you can see from industry, people with deep pockets buying cheap dry bulk tonnage. But the question I wanted to ask is, we haven't heard the words Chapter 11 mentioned yet on a restructuring panel. Do you think that that is going to be a route, or do you think it's in everyone's interest to avoid getting to court and not wasting money on expensive lawyers and restructuring advisors?
Well, speaking as a lawyer, Chapter 11 is never a waste for the lawyers. So, but I'll let our panel answer the real substance of that.
I can start. I think that Chapter 11 is a tool in the toolbox, like everything else. And there may very well be a good play for offshore owners, like other shipping owners, to file for Chapter 11 or consider a Chapter 11 proceeding. I do think that it's critical that before doing that, this is not a decision that should be entered into lightly, and there is a lot of work that should take place beforehand to develop the strategy of what it really is that that you're seeking and what it is that you're willing to give. And I think that discussion, and it doesn't have to entail, a pre-pack or anything like that, but I think that there is a lot of work on the front end that needs to take place between a ship owner, their constituents, and advisors to determine whether or not the specific situation that they're in is one that lends itself to a Chapter 11 proceeding that would have some sort of equitable outcome.
Yeah, I mean, I would agree with that. I mean, I think it's exactly the way it was described. I mean, it's a tool to be used. It helps us get sometimes everybody to the table. I've been on both sides, on the debtor and the creditor side in the Chapter 11, and ultimately you're looking at getting a deal done, and just as we said, as Evan said earlier, I mean, everybody's taking pain now, so there's definitely you might want to stay out because of the cost associated with it, the stigma associated with it, but then you also might want to, that might be the play to get everybody to the table and get rid of some liabilities maybe you didn't want or some other things. So there's a deep analysis that needs to be done.
Yeah, we had a few while I was at DVB. Some were useful in sort of clearing out a large group, and that's the only way you could deal with a large group of lenders or debtors in the situation. Some went in with pre-pack. The flavor I've seen now, and I'm far from the expert, is it's more of a leverage point. When you see more of the bilateral deals being done, and the owner's going, well, I can tip it over into Chapter 11, which you, Mr. Banker, is not going to like, and it's just going to be a waste of time. But I don't see it as the preferred choice of anybody, but just more of a bargaining chip these days.
I mean, I can only add to that we are definitely seeing an increasingly number of insolvencies in Germany. I mean, banks are willing, I think things which haven't happened in the last 12 to 24 months, it's happening now. So banks are threatening, and banks are taking the action and putting vessels into insolvency.
Okay, I think we have another question over on this side of the room. Yeah, there. So just to sum up, Chapter 11 can be a tool. It can be either a hammer used to smash through with the banks, or it can be a screwdriver to sort of fine-tune things, at least from the lawyer's perspective. But yes, your question.
Yes, thank you. I think it was, I think it was Esben and Ivan who were commenting a little bit about it has become a little drier as far as either the alternatives or the equity, the private equity folks coming through. Could you add a little bit more on that? Has there been, for instance, regulatory that has become an obstacle, or things that there is a little bit of a bigger wall for, let's say, a foreign investor, or is this much driven by valuation gaps between the bid and the ask?
I can start. I think there's a lot of plays a lot of factors at play here, but I think, to me, some of the big ones definitely in the dry bulk space, and as an example, the ever-dropping valuations is a huge problem. If you're, at the end of the day, this is an asset play for most, and if you don't feel that you have a good view on what the bottom is, it's hard to find a price point that you can get comfortable with. And I think, in addition to that, a lot of those investors that were around and were interested and enthusiastic about stepping into the capital structure, in the recent years, are now in these capital structures in a lot of these companies and are trying to find an exit. And my sense is that until some of those exits occur and that crystallizes itself, there's been sort of a dampening interest in committing more funds and capital to this sector, because we are sort of already over-leveraged in a sense. And really, to me, a lot of that interest from alternative financing is what was the catalyst in a lot of these restructurings that we saw in the first wave, converting debt to equity, or making sure that the restructuring moved forward. And so I think we're going to have to have that shake out before we're going to see a significant uptick again from those types of financiers.
Yeah, I don't have much to add. I agree with that.
Okay, are there any other questions, or?
Gene Richards over there.
Oh, yes, yes, Jean.
Thank you. Jean Richards, Second Wind Shipping. I have a question for the panel. We have seen in the past that it's the optimism of the owner that then encourages the banks to actually do the first restructuring and not a realistic restructuring. Do the panel feel confident that if they do a restructuring without repossessing the owner, it will be the first restructuring and not the final restructuring? And how long do they optimistically think their restructuring might last? 6 months?
Yeah, I'm not a huge fan of that cliche, kicking the can down the road, but everyone who did a restructuring over the past 5 years really didn't plan on the market being down for 7, 8 years. So it was a fair deal when they did the first restructuring. Nobody went into it thinking, we're going to have to do it another time anyway. Would have done it differently, would have taken more options.
Yeah, I think I generally agree with that. I think that certainly there were some transactions that were done that you could say were more optimistic than others and allowed a shorter runway. But there were a lot of other transactions that were done that created significant deleveraging and a longer runway. I think this time around it's a little bit different, the calculus anyways, because it's not only about kicking the can. Real dollars has to be committed to fund the companies in the interim. So I do think that calculation around somebody has to contribute real cash now. And so who is that somebody going to be, and what sort of runway does that buy us? I do think that equation is becoming a bit more bearish than it's been before, because it's real money up front rather than a re-amortization or a kicking the can.
I started the negotiations at 24 months, Gene. That's what.
Oh, and to repeat the question so everyone can hear, how long is the restructuring now? How is it going to last? How long is it going to last? Which I think is another way of saying, how can you tell if a restructuring is successful? What is a successful restructuring in this market?
So we answered Gene's question. We said 24 months and enough cash to get the ship owner there.
Okay, any other perspectives?
Yeah, I guess, I don't know, I'll try to answer it better so you leave with a smile. I think a successful restructuring, you have different, in this market, where the vessels are tied to really the rates, and we're at, historically low rates, I think you need that runway, and you need the time to be able to turn around. And if you're operating at a loss, right, then you need to figure out what to do. You need a successful operating plan, something to get yourself by. And then if you're over levered, then you need to then have these discussions with the banks, and so it's going to be more complicated, that next step. So I think as we've discussed, I think you have to have a credible plan, something that management, that the debtor, feels that they're comfortable going to the banks, going to your investors with, and if you can get there and stick to that, then hopefully, as we hope that everything's turning around in 2017, then it'll be successful.
Any other questions? We have time for one or two more. And if not, I'll just monopolize the questions. Okay, so now the big finale question. Of course, we have to ask, what does the future hold? What are your predictions for this coming year? Not naming any companies, but what do you see coming in terms of restructuring, maybe that hasn't already hit yet? Or do we just see more of the same?
Well, I think clearly, I think this is a sector discussion, and the dry bulk sector for sure, our expectation is that we will see more activity on the restructuring front than we've seen certainly in the last couple of years, and probably more activity with that may involve filings to the extent that restructuring has to be effectuated or the stakeholders can't agree. I also think that some of the other sectors we're going to see activity. Personally, I'm fairly bearish on the container space. I think in the tonnage side is an area that I'm concerned about. The carriers are going through very tough times. They're still plagued with overcapacity, and I think there's a big change in that space, and that's an area that we're watching very closely. And then, of course, offshore is one of the people in the audience were asking about. That's an area that we are seeing as well. So I think from a Chapter 11 perspective, my prediction is we will see more activity than we've seen in the last couple of years in those sectors as a starting point.
Yeah, I agree, and I also think that, one of the challenges is going to be what the banks actually really do with their provisions. I think the bid-ask is, the spread's still a little healthy, so I think, as we see banks starting to write those down, and we see some of the banks actually getting out of the lending business into the space altogether, I think we will need to see some more activity.
Well, I think it will be a good sign for us to see what's actually going to happen with HSH and the whole process of this bad bank and good bank, how that will develop. And I think we will see some signs there in terms of pricing tags, and I think that will obviously lead to other actions within other German Landesbanks. And plus that, I think will lead definitely to some concentration and some mergers within Germany or within the shipping industry, probably led by some of the banks.
Yeah, from my side, I don't have much to add for it. A bit sensitive to the dry bulk side, would probably be a slow recovery.
And on that note, please join us for lunch. Thank you so much
No,
for your participation.
I had a question.
Hope you don't mind, I closed it out.
So Capital Link to me is a very important forum for the shipping community to have a chance to get together with influencers, bankers, professionals that are involved in the shipping industry. And it's really a unique opportunity for people like me in my profession, the restructuring community, to have an opportunity to have all the different players in the same room, exchange ideas, potentially get to learn something new, and just really catch up with the folks that shape this industry on a daily basis. I think the message this year is, from a restructuring perspective, is a mixed message. We have obviously the dry bulk sector that is in a historic downturn and in a very, very challenging situation. But I also think we have bright spots in some of the segments. The tanker market is doing well. So I think from my perspective, it's similar in some sense that we've been in several years of downturn, and owners have to be diligent. The influencers of the industry have to be mindful of their investments, but there is opportunities for people that are willing to invest in the right types of situations. So in some sense, it's similar than what it's been in recent years.